Hello and welcome. You're watching KYC. Today we're going to talk about a reasonably large company, 25,000 crore in market cap, is the largest standalone health insurer in the country, which is Star Health, and a company in which Rakesh Jhunjhunwala had a stake pre-IPO and continues to hold. So that's where it starts to get very, very interesting. And why is Star Health so interesting is because from the point of IPO till now, we've seen a sustained underperformance in the stock price. And can that underperformance actually change? Can there be a turnaround is really the question we're asking today, and probably we'll hopefully find answers to that. Trends with regard to competition and pricing in the health insurance space, that's the other thing I want to talk to them about, because Lombard has come into health insurance in a big fashion. So we have a large competitor coming in a big fashion, and therefore competition is tough. On top of it, they already have a market share of 33%. How much higher can it go? That's really the question. Is that sustainable in terms of a trend, or will they just try to maintain the 33%? Maybe some indication there as well. How much can the combined ratio improve? Now, in layman terms, the combined ratio is nothing but a measure of profitability on the top line. It factors in the expenses, the management expenses and the overheads of the company, and thereafter factors in all the claims that the company has received and paid out. And thereafter, you arrive at the bottom line profit. So a combined ratio of 100% will mean you're at a no profit, no loss in your business. A sub 100% will mean you're starting to get profitable. And above 100% means you're yet to break even on the operational side of the business. So I want to understand where does that go and how much can it improve by. What to expect on the investment income front. So one part of the top line is obviously premiums that you make as a health insurer. The other part is the investment income that you make on the money that has already been deposited with you by the customers. Say, for example, you're a customer in a health insurance company. You've paid out a premium in year 1. In year 3, how has the company reinvested that premium, earned a yield on it? That essentially is the investment income. And there are certain levers which they are trying to tweak with regard to the investment income. So we will try and understand that. What are the levers, therefore, for profit growth? We'll speak about the combined, we'll speak about investment income, we'll speak about top line growth, and therefore, those are the key levers, of course. But how do they move, and therefore, where does profit go? They've guided for a doubling of profit, a tripling of profit, I beg your pardon, and doubling of top line by FY28. So I want to understand how confident are they of that journey. What is their ROE target? Because at the end of the day, shareholders want returns, and your returns are linked to the ROE number that the company clocks. So is there an ROE target internally, and how sustainable is that target across cycles? Because with COVID comes health insurance claims, and therefore it's a cyclical business of sorts. So you want to understand how sustainable that number is as well. We'll try and explain and try and get an insight on all of this. But first off, as we always do, let's start off with what the company is all about. It's, as I did mention, it's the largest standalone health insurer in the country. It was founded in 2006. It's pure play into health, focused on retail, which is individual and family. And it also now has started to do wholesale in a bigger fashion. It commands a 33% market share in the retail health space, 44% amongst standalone health insurers. It has a network of 900 branches, over 7.5 lakh agents, and 14,000 partner hospitals. How the model works is, you pay a premium to the company. If at all, God forbid, you were to be admitted to a hospital, the tie-up with the company ensures a cashless claim to you. So therefore, this number starts to become important when you're looking at a health insurance. Now, last off, it's a listed entity, major shareholders, and it got listed in December of 2021. Major shareholders include the rights of a Westbridge as well as a Jhunjhunwala family, all of which sit within that promoter group. So you want to take care of that when we go to shareholding pattern in our metrics. Now let's look at the products. Retail health insurance is the flagship product. There's also group health for corporate, SMEs, MSMEs, and There's personal accident and there's also travel insurance. They have cancer care, autism care, cardiac, women's health, and braille policy. All of that is an industry first, is what they pride themselves for. They've done innovation in terms of digital products, wellness integration, and they have certain sector first features. Ayush and mental health is covered in all of their retail plans. So something again which stands out. Let me talk about the business model, and I spoke a little bit about it. So first off, it will sell health policies. It will collect a premium. That premium will be collected over many, many years. Hopefully you don't have a claim. Good for the company, good for you as well. And that premium is invested. Invested in where? Debt, equity products, right? And a percentage of the loan, the mix of equity is going up. It was sub 15%, it currently stands at 17.2%, just for your knowledge. The core revenue, of course, comes from premiums. In terms of the channel, 82% of the premium comes from the agency channel. It's expanding in digital as well as banca insurance, which is the banca channel, which is selling policies through banks. That's also something they're focusing on slowly and gradually. Otherwise, they've largely worked with agents. They sell to retail customers, but now have started selling to MSMEs, group businesses. The competition, of course, is the likes of an HDFC Ergo, ICICI Lombard, a Max Bupa, a New India, a Care, and market share. They have 33% of market share. We've spoken about that. Some concerns. It's a single line of business. They don't do too many lines of business. So that's one possible concern to take care of. Also, the claims have been elevated in recent years. COVID was one tipping point, but outside of that as well, claims have been elevated. The loss ratio has held up around the 70% number, which is a bit of a concern. Even though on the retail health side, the loss ratio is 65%. Because of wholesale growing, the loss ratio is elevated. There's a slowdown in profitability due to certain underwriting losses that they are making, especially with regard to claims. A claim ratio, a loss ratio is largely the same. That's how we're seeing the likes of a Star Health. Now, let me talk a little bit about the key metrics that we'll focus on. An insurance company, and therefore, you want to understand that the metrics might change a bit. We look at the income statement, then we look at key ratios, and I'll stick to only the key ones. I won't try and give you the whole hog. The balance sheet as well, we look at return ratios, we look at shareholding pattern, and everything else remains the same: street cred, street coverage, and valuations. So that's how we'll stack it up on a KYC in terms of the metrics. Let me start off with the income statement. Now, if you look at the income statement and how it's evolved, the net premium is around 14,800 odd crore in FY25. The 3-year CAGR on that is around 15 odd %. And it's been a steady growth, frankly. FY22, it was sub 10,000. It grows to around 11,000 in FY23, as you can see on your screen. FY24 was nearly 13,000 and currently sitting at 14,800 odd crore. So you've seen a steady 15% kind of growth. Your investment income, and I explained this, is up 18% on a compounded basis. Your claims, which also we spoke about, FY22 as the base has gone up by 7% CAGR, but FY22 as a base is an extremely tough year. Mind you, we had the second wave of COVID in the middle of 2021 calendar year. So therefore, the spillover of that has happened in FY22. And therefore, the claims in that year were quite large. It was significant. In fact, the claims ratio at that time was an 87% versus the 70% currently. And the claims ratio gives you the ratio of the claims versus the top line. So it was quite large. It was significant. So from there, from that higher base, it's grown at 7% CAGR. Just giving you that perspective that claims were anyway elevated, and on that base, the 10,000 crore of claims in FY25 still looks quite a bit elevated. You might want to work on that claims number, especially where Star Health is concerned, something you want to see. Where OPEX is concerned, this has been a steady state. They've been able to control OPEX well. It's been 11% 3-year CAGR on that OPEX number. And the commissions number, mind you, they have to pay commissions as well to their agents for every policy sold. So their commissions number also grew in line with the top line, which is 15 odd %. So no leverage being taken on the commissions number, but some leverage being taken on the OPEX number. So that's how it essentially looks like. Now let's look at key ratios. The combined ratio sits at 102.1% in Q1 FY26, so it's quite elevated. I explained to you that the combined above 100 means that on an operational top-line basis, on the premiums, the company is making a loss. So therefore, you want to start to see how does Star Health make a profit, right? It's on the investment income technically that they start to make profits. But broadly, this is the problem. The combined ratio has been elevated. FY23, we saw the combined ratio sink to 95%. FY22, it was elevated understandably because of COVID. We did discuss that. FY24, it spiked up. FY25, it spiked up further. And FY26 Q1 has been at 102.1%, so quite elevated. When you're looking at the investment yield on the portfolio of investments, it's come off, and that's also because debt or the cost of debt has come down, and therefore you're starting to see investment yield come down to a certain extent. That's probably what's hurting the number. When you look at the claims ratio, that will give you perspective on what's hurting the combined. And the claims ratio, 87% in FY22, sank to 65. In the year in which it was 65, very good profitability. 66.5, very good profitability. FY24, we looked at that profit number. It was extremely strong for FY24. FY25, 70%. Q1 FY26, 70%. So you want that claims ratio to come down. We've given this a neutral as well. Because if the claims were to come down, there is scope for profit expansion. So you want to wait and watch whether that actually translates or that does not. Balance sheet, and this is of course more broad-based in terms of how one looks at the balance sheet. You look at the net worth, which is around 7,300 crore. It trades at around 3.5 times price to book, which is on the net worth. The net worth grows decently well. Around 2 to 3% every quarter is what it's been demonstrating in terms of growth, maybe 3 to 4%. And the investment that it makes is on that bottom line, 18,000 odd crore in terms of investments. Let's look at the return ratios. And again, volatility is evident. FY22 was a bad year, so was FY21, understandably. FY25 was sub 10%. So we'll give this one a neutral as well. Let's look at shareholding. And this is a clean thumbs up because you've got very good shareholders sitting here. No explanations needed on this one. Let's look at the street cred. How has the street rewarded shareholders? 4% up in 1 month, 1% up in the last 6. Year to date, it's been a dismal negative 9% return. 1 year, the stock is down 29%. And since the IPO, the stock is down over 50%. So could this be a potential opportunity is really the question. And of course, we'll have to understand and wait and watch for that. But let's look at valuation straight up. And you look at the price to book, we spoke about that. It's currently trading at around 3.6 times book. This is FY25 book, mind you. We looked at Q1 FY26 book. But broadly, that's the number. The price to earnings ratio is around 40 times. And the 4-year average price to earnings since FY21 listing is 41 times. So very, very neutral on this count. But if the profit were to double by FY28, the price to earnings will shrink very, very rapidly. And that's where you could see an opportunity. So you want to wait and watch as to what's happening here. And the re-rating could be sharp if management guidance is followed. Because from the 600 or to 700 crore PAT that they're doing currently, they could well do 2,000 crore of PAT by FY28. So you want to see whether that is doable or not. We'll wait and watch for that. Now, last off, on analyst recommendations, there are 14 buy calls, 6 hold calls, 5 sell calls with just a 4% upside on this stock. Not looking pretty, but given the kind of buy calls, we've given this a neutral again. And therefore, that stacks up all of our 8 KYC rating parameters. Let's go across and see what is the final rating that we get for a Star Health on KYC. Pretty much all neutral. Shareholding is a clear thumbs up. Street cred is a clear thumbs down. Street coverage and valuations too are neutral. 4 out of 8 is what Star Health gets on our KYC rating, but plenty of moving parts, a turnaround at play. Let's go across to the management. We spoke to Mr. Kambli, who's the CFO of Star Health earlier today. Let's go across, listening to a slice of that. How are you tackling, so let's go line item wise. In terms of top line growth, how your growth seems decent. Can you hold on to market share? Can you build on the market share? Is competition coming in a big fashion? How are you standing out? Just talk to us about top line first, because that is your key driver for bottom line growth, is what you're saying.
Yes. So, as we see for the quarter for last year, we have been holding to our market share of 33% on an annual basis. For quarter one, the market share is 31% when it comes to retail health. With the kind of scale that we have in terms of our agency base, the way we have built our digital business, we believe we'll be holding on to the market share as well as keep on improving on it. But in the areas where we want to focus, we just don't want to go all out. We see a lot of growth shown by competition, but that is based on portability. Portability for us is only 10% of the fresh business. So we continue to grow with all the operating parameters working in our favor. In terms of competition, we see that competition is always there, will be there. It helps to expand the reach of insurance in this line of business.
Sure. So pricing at this point, do you feel there is still some price hike warranted, or you're comfortable with the way pricing is played out over the last 12 months and now no more price hikes in the system?
See, we believe that pricing is an annual thing, with the kind of inflation and the severity that we see. Pricing is an annual exercise. We have taken price increase for 65% of the portfolio last year. It's in the range of 8 to 9%. If we go back in time, the pricing used to happen every 3 years, which was in the range of 20-25%. But what we see is that the annual pricing is much more relevant. It doesn't pinch the pocket of the customers, and it helps us to bridge that gap in terms of loss ratio. So the price increase will be an annual affair for our portfolio.
Got it. But sir, so how does top line growth ensure that you get a better combined ratio? Because largely, wouldn't you believe that new customers coming in will have a similar kind of a vintage?
Absolutely. So when we talk about price increases, we talk about claim-based discounting as well. The customers, who are not claiming, we have our, provisions to give them discounts. We have various methods to give discounts to the good customers. We have something called as a network-based discount. Customers who are ready to take treatment in good hospitals, not necessarily in tertiary care hospitals, there is a discount available to them. So while ensuring affordability of the price for the new customers, we ensure that the overall portfolio yield is maintained. And that is how we want to maintain the loss ratio of the business.
Right. So now the other line item with regard to investment income, your investment yield has actually come off. It's come towards the 6.5%, but the equity as part of your investment corpus has gone up in percentage terms. And that tilt is likely to continue towards equity going forward. Give us that perspective, and therefore, what is the impact on the yield maybe over the next 2 years that you're seeing?
First is to counter the 6.5%. The equity investments, the rates investment, which does not have a fixed income flow, is now 17.5% of our portfolio. Now, if you calculate only the fixed income yield on the total portfolio, it will always be lower because we have increased our proportion of equity business. What we see is, with a mix of fixed income and equity portfolio, the average portfolio yield should be closer to 8%. That's the objective of the business. Whereas when we invest only in the fixed income, it is closer to 7.25%. So we see with the right mix of fixed income as well as equity portfolio, the yields to improve over a longer periods of time.
Got it. So where should your combined, or where do you envisage your combined? And I'm not asking you for a guidance, but just for a broad parameter on where one should envisage both combined as well as claims in terms of a ratio. And I'll go into retail versus group. But for the moment, just combined versus claims over the next 2 years, where should that number broadly go towards?
See, Hersh, what we're looking at is a ROE target. We see that claim ratios will be a function of the pricing by the healthcare providers, by the company, a mix of retail and group, a mix of indemnity and benefit. So there are various factors that will play out. what we are saying is we want to maintain an ROE target, which is upwards of 15-16% over the next 2 years period, by FY28. That's our stated objective, and we are well on course to achieve that. We believe as a measure to improve operating profitability, expense ratio has to be controlled. A lot of effort is going into it. Claim ratio can be slightly cyclical as well as a function of the various product mix and the indemnity benefit, all those segments of the business. But the objective is to ensure a healthy ROE of 16% and above on a consistent basis.
And how confident are you of achieving that, sir? A 16% plus ROE consistently?
So we are very much confident. All the business actions and the strategy that we're working is playing out. We are confident about it, and there is a clear strategy to achieve that ROE targets.
Point taken. Okay, I want to also delve a little bit into competition. I know you've touched upon it, but there is one competitor in particular which has been aggressive in the health insurance market. Do you believe that the growth, therefore, might be limited in terms of a window? I know you've grown 18% excluding 1/n, which is the new accounting norm. But excluding that, I know you've done well. But do you see pressure there on that number?
See, again, we believe India is a huge underpenetrated market. The options are huge. You have to see the business that we come from. A very significant portion of the business is from tier 2, tier 3 cities where we are the market leaders. Even in all the states of the country, we are the market leaders. And that's true because of our agency workforce, because of the investments that we have made in digital, because of the product innovation and the product features we are able to come on a regular basis. So we believe competition is good. Competition is there and will always be there. But the strategy that we work with will ensure that we maintain and improve on our market share.
Okay, so that's all the time we have on KYC today. In fact, that was management interaction with regard to a Star Health. The stock perked up in trade on the back of numbers. Stay with us. Completely out of time on KYC, but more action will follow.